Bullish and bearish fair value gaps, or BISI and SIBIs. Buy side imbalance, sell side inefficiency is the bullish fair value gap. Sell side imbalance, buy side inefficiency is the bearish fair value gap. Now we can move on to breakers. We have the bullish and bearish breaker. In a bullish breaker, price creates a low, a high, lower low, then a higher high. Once it creates the higher high and price closes above this previous high right in here, you're hunting for an up close candle or consecutive up close candles in the price leg that creates the high. In the bearish example, we have a high, low, higher high, lower low. You're looking for a down close candle or consecutive down close candles in the price leg that makes the low. When price closes over the high, that is kind of like the basic entry pattern for a breaker. Is it kind of validates it when it closes over the high in the bullish example. When price returns back to the breaker, that would be the long entry. We'll also go over some potential stop placements later in the series. This isn't the main model that I use to trade, but I can use it as confluence and also for targets. But it's important to understand this PDRA just because there are certain scenarios where I do refer to it. So in this example, when price creates a lower low and closes beneath this low, or the down close candle, or consecutive down close candles in that low, when price returns back into the down close candle in here, this would be the short entry in the breaker. So this is what bullish and bearish breakers look like. There's not too much to add here. In the bullish example, we're looking for a up close candle or consecutive up close candles in the price leg that makes the high. In the bearish breaker, we're looking for a down close candle or consecutive down close candles in the price leg that makes a low. So now let's take a look at a real chart example. And I want you to pause the video and try to identify a breaker. I haven't even looked at this chart beforehand. I just glanced at it because I want to show you guys what goes through my mind when identifying breakers, because it's just second nature to me, and that's because I've spent a ton of time back testing it. And that's the way you're going to get the most familiar with these concepts, is by spending a lot of time looking at it and studying it and journaling it. That's the most important part. So just take a second, pause the video, and just try to identify a bullish or a bearish breaker. I'm going to mark out both. So if you look over here, we do have a bullish breaker. And the reason that this is a bullish breaker is because we have the exact signature that we just talked about. So I'm going to go ahead and I'm going to copy and paste this over. And you'll notice that we have this exact sequence going on. So price creates a low, a high, a lower low, then a higher high. So you can see over here, low, high, lower low, higher high, low, high, lower low, higher high. So what we could do is in this price leg that creates the high, we're looking for an up close candle or consecutive up close candles. See how there's two in a row? So we have this candle and this candle. Since there is two in a row, I'm going to mark out both of them and extend them over. So this is my bullish breaker. Now, Dan, why aren't you just using the last up close candle? Because there's two in a row. If this up close candle right here was a down close candle, I'd just be using the last up close one. Since it's two in a row, I'm using both. Now, the last up close candle is the sweet spot within that breaker, but this is the entire breaker because there's two up close candles. So again, low, high, lower low, higher high, price breaks above that. What about in here, Dan, when it's just consolidating in here? This is just time distortion. So this does not validate nor invalidate the breaker by price chopping around in here. My main concern is that price broke above it and then closed above it. Now, Dan, what if it fails to make the higher high and then it just continues lower? That's not a bullish breaker then, right? It would have to close above it. There are ways to pick out a bottom in here, right? If you really know what you're doing, there's ways to pick out a bottom in here and anticipate for a breaker to form. We'll be talking about that in this series as well. So when price breaks higher and closes above it, when price retests it, if the draw on liquidity is higher, this is an area where the algo will refer back to, which it does right here. It just taps into it. Notice how it just taps into the breaker, then expands higher away from it. This is an area to hunt for lower time frame setups in here. But that's the basics of a bullish breaker. And here, if we go down into a lower time frame, right, I'm just randomly seeing this, we have the same exact idea. So we have a low, high, lower low, higher high. So what I can do, look in this price leg from low to high. Is there an up close candle or consecutive up close candles? See how there's three? Well, I'm going to mark out all three then. Price closed above it, right in here. Price consolidated in it. And this is an area where the market can refer back to before seeing higher prices if the draw on liquidity is higher. So you see all these YouTubers talking about this is the bullish breaker. As soon as it forms this, buy. As soon as it forms this, sell. No. If you're just looking for the pattern, it's going to be useless. Because I can look in here and I can spot bullish and bearish breakers. I can make the case for both sides of the market. This is a bearish breaker in here. So I'm not just going to cherry pick ideas. This is a bearish breaker and it failed. So now we need to know, okay, well, why did that fail? That shouldn't have failed, right? Well, it should have. And the reason is because the draw on liquidity was higher. So this is an example of a bearish breaker where we have a high, low, higher high, lower low. Once it creates the lower low, closes beneath it, this previous low right here. So once this low closes beneath this one, we have a valid bearish breaker. So we look for a down close candle or consecutive down close candles in the price leg that made the low. So again, high, low, higher high, lower low. See how there's only one down close candle? I would only use one. So price returns back to it, but then it cuts right through it. So Dan, why doesn't that act as resistance? Because the draw on liquidity is for price to head up to the buy stops up here. Okay. If the draw on liquidity is higher, you do not want to hunt for bearish signatures in price action, whether that be a bearish fair value gap or a bearish breaker. If we zoom in here, we can go down into a 30-minute time frame, right? You can spot these anywhere. I'm actually going to go down into a 15-minute for this example. So notice we do have a low, high, lower low, then a higher high. So this, we're looking for a up close candle or consecutive up close candles in the price leg that made the high. See how there's just one up close candle and this is the highest one. So look for the highest up close candles or consecutive, right? Or up close candle or consecutive. So in here, there's only one that's the highest. Why not incorporate this one too, Dan? Well, because this one went higher. So if I delete this, you'll probably see what I'm saying. I'm not going to mark out these two right here because this one up close candle went the highest. So this is going to be my bullish breaker. So I'm going to mark that out. I'm not going to be looking for bearish breakers because the draw on liquidity is higher, which again, we'll be talking about later. Now, when price was bearish, how can we identify some bearish breakers in here? So over here, notice we have the high, low, higher high, lower low. In this price leg that creates the low, you're looking for a down close candle or consecutive down close candles. That's going to be the bearish breaker. So we have that right here. Price returned to it and then expanded lower. Why am I not using this lower wick right in here? Well, because it's just the two down close candles. From my experience of trading ICT concepts, I've only seen him mark out the two down close candles and he won't incorporate that lower wick, whether that's significant or not. Meaning whether the wick is large or not, he's still just marking out the two down close candles. From my experience, that's what I've seen. But the reason I'm selecting these is because we have a high that formed right here. We have a low, higher high, and then a lower low. So once it closes beneath it here and price returns back to the breaker, that's going to be an area, if the draw on liquidity is lower, for price to expand off of and trade lower. You can see that we have a bearish fair value gap in here. The algorithm's referring to those bearish PD arrays as it's targeting these levels of sell side liquidity right over here. So that's an example of a bullish and bearish breaker. We do have another one over here. So price creates a high, low, higher high, lower low. So in this price leg from this high to this low, we're looking for a down close candle or series of down close candles. We have that right there. Price rejects that and then expands much lower for the sell side liquidity. So that's going to be it for breakers. Let's move on to bullish and bearish order blocks. You can see that we do have a bullish order block here. Similarly, in the order blocks, just as it was for breakers, we have a down close candle here. If there is a series of down close candles, you'd mark out the series. I'm going to be diving into that in a second, so just stay tuned. A bullish order block is when price creates a down close candle or series of down close candles and price breaks over them, creating a bullish fair value gap. So once it creates the bullish fair value gap in the 2022 ICT mentorship, that's what makes it a high probability order block. Just because it has the title a high probability order block doesn't mean every time it forms it's a high probability trade. You need to understand where price is going, and you need to understand where to look for the setups. We're going to cover that in this series. So right here, price breaks over this bullish order block and it creates a bullish fair value gap. So again, from this candle's high to this candle's low, creates this imbalance in here. Once price does that and it closes over the order block, creates the imbalance, right? This becomes a bullish order block. High probability bullish order blocks are when price takes out liquidity, makes a market structure shift, which it does right above this candle's high right in here, and also forms an order block, or forms a fair value gap event. Similarly, in the bearish idea, you could see that price has an up close candle right here, breaks lower, creating a bearish fair value gap. Okay. Also a market structure shift by breaking beneath this previous low right in here. So it would have created a market structure shift there. And high probability order blocks will also run out liquidity. So this is what a bullish and bearish order block looks like. The down close candle is the bullish order block in this example. The opening price of that down close candle is the sensitive point of the order block. So price typically will return back to that open and then expand away from it. Price can also return back to the 50% point. So when you draw a Fibonacci from the swing high to the swing low, I'm not using Fibonacci ratios, I'm just figuring out the midpoint of this down close candle. Price could return back to there. If you're bullish, you don't want to see it close beneath 50%. If it were to close beneath 50%, or mean threshold, that's what ICT calls it, MT, mean threshold. If it were to close beneath 50%, it's more likely that you have the wrong draw on liquidity and price continues lower. Doesn't mean always, but there is a high probability chance that if price closes beneath the 50%, that it's likely just going to continue towards the lows down there. The same exact logic applies for the bearish idea. The up close candle is the order block. The opening price of that up close candle is going to be the sensitive point of the order block. You could also draw out mean threshold, which is 50% of the order block. Price could return up to there. If you're bearish, you don't always want to see it return back to 50%. And if it were to close above it, then it's likely to just head for the high. So you don't really want to see something like this. If it were to close above it, it's likely to just run out the buy side higher. When price returns to the opening price of the order block, this is the sensitive point, and that's likely where price will reject or in that vicinity before price continues lower if the draw on liquidity is lower. This is a bullish and bearish